CNBC's Delivering Alpha quarterly stock report is out. They poll mutual funds, hedge funds, strategists, and CNBC contributors about their strategies for the upcoming quarter and year. We asked about the market impact of Russia's war against Ukraine and whether investors think the uncertainty will change the Fed's planned rate hikes roadmap. The majority said the war will likely not impact the Fed's policy very much. In the meantime, about another third of investors think it will force the Fed to actually raise rates faster, while 19% said it will likely force the Fed to slow down their plans. Let's bring in now Bill Stone, Chief Investment Officer at the Glenview Trust Company. Bill, thank you very much for joining us. Maybe you were polled. I don't know. How did you answer that kind of poll? What do you think?
You know, I think you talked about it earlier in terms of the yield curve being very close to inverting. As you mentioned, there's a lot of complications with it right now in terms of real versus nominal yields. But I still think you need to position yourself ready for what may be an eventual recession. And while I would say that is, I think you focus on quality companies, which is just really companies with high returns on equity and also lower debt levels. That really gets you through some sort of an economic slowdown. Again, you have some time because typically you're talking something like 12 to 18 months after the inversion that you actually have a recession. And usually the market doesn't top out until 6 months to a year after the inversion. So there's probably some time here. But that being said, I think it is wise to, because you never know, right? I mean, it can happen quicker, it can not happen at all. But either way, you're in good shape with quality companies.
You're making a very important point, which is for investors out there who are watching that, close to inversion, pseudo inversion, whatever you want to call it, or even just feel like there may be a recession coming for other reasons. Stocks can rise even into a recession, maybe not during, but to your point, Bill, that the next 6 to 12 months, if we get a recession next year, stocks can still go up between now and then. And if you sell now, you may be leaving some money on the table.
Yeah, and if it's I'll say a generic recession, not connected to some sort of a bubble or a, financial crisis, you're talking it could be 20% off the peak, 25%. That's kind of where you might see it. Again, not pleasant, but, we weren't that far from that not long ago this year, So, I think it's not good to necessarily run away, but you do want to make sure you're in companies that can survive a recession. I think that's the key.
And like who? Can you give us one example before we let you go on this fine Wednesday morning, Bill?
Yeah, I think Starbucks, something that sold off in the growth wave, but again, it's not going to go anywhere. They can pass along price increases. There's obviously worries about their Chinese growth, but again, once China reopens, I think that growth will pick up too.